Welcome back to this week's Liquidity Podcast. With me today, I have Logan Allin from Fin Capital. Next, we have Neil Datta from NKD Advisory. Of course, we have Jason Calacanis from the Launch Fund. I'm your moderator, David Weisburd, co-founder of 10x Capital. Today, we have several interesting topics to discuss. Vinod Khosla sounds off on AI developments and regulation at the Collision Conference. Trump weighs in on H-1B visas and green cards. And Carta releases data showing how long it actually takes to succeed in a startup. We'll end the show with the latest three investments from the guests. Let's dive right in.
And hey, as we start here, I just wanted to say thank you for a moment to some of the amazing partners we had at the Liquidity event in June in Napa, David. A great event. I think you had a good time, yeah?
Yeah, it was a great time.
So thanks to some of the folks who sponsored dinner and lunch, Aventus Advisory. They're a leader in on-demand finance and accounting support. Venture, they provide end-to-end solutions for payroll, HR, benefits, and risk management, and Forge Global, which provides investors and shareholders a transparent view of the private markets. Thank you so much to our partners. All right, big docket. Let's go.
Yeah, let's go. So Vinod Khosla spoke at the Collision Conference in Toronto and discussed several pretty interesting topics. He's not very interested in deal making, hasn't personally taken a single dollar of management fees since starting Khosla 18 years ago. His concern of the US going the way of the EU, which has regulated itself out of leading technology innovation, and the implicit nod of confidence that Apple and Tim Cook has bestowed on Sam Altman through the Apple OpenAI deal, which he believes expresses confidence into Sam Altman's ability to lead developments in AI over the next 5 to 10 years. Neil, you got a chance to listen to the talk. What did you think about Vinod's talk?
Well, it's not surprising to hear a prominent venture capitalist push back against regulators. I think at a high level, I do agree with his premise that the passage of the act is going to have a profound impact on the industry. But however, I think it's much more nuanced than the standard argument of government overreach in terms of regulating new technology it may or may not fully comprehend. And I think the act itself, if you look at it, there's two primary areas of focus, right? There's the privacy section and the kind of risk section. And the privacy section, it mentions things like deep fakes and social scoring systems, and it creates controls around that. And I think stuff like that we could all agree about and get behind. The area that I think is concerning for hardware makers and software makers is the inclusion of, companies based in America trying to sell product or software to the EU. However, if you look at the history of the EU historically has taken a leadership role in regulating technology. The two instances I could think of is in 2002, the E-Privacy Act, which effectively forced websites to disclose cookies and tracking, which we all enjoy today. The other thing that is GDPR, which ultimately led to things like CCPA and other privacy laws around the world. So ultimately, the EU has historically taken the kind of first mover approach in terms of regulating technology, but a lot of it is TBD. So I think it's super nuanced and worthy of regulation playing out.
Jason, you've talked about kind of the side effects of EU regulation, how some businesses may avoid the region. What are your thoughts on EU and its position on a global scale?
Yeah, I mean, it's a pretty tight filter. I think most of the companies in M&A that are, most of the, let's say, ticky-tacky, what would we call them, tactics that companies are getting dinged by in the EU are manageable, and other ones are seismic, right? And so it's very early to start regulating AI. I think it's all regulatory capture, and generally we just need to use existing laws and maybe keep an eye on it. So I don't mind like an exploratory committee and that kind of stuff. I do get a little concerned when they want to regulate something so early on because we don't even really know what we got yet. Now, when we look at something like USB-C cables and iPhones and versus Lightning, in a free market, one might suspect like you could pick whatever charging cable you wanted for your device. The EU put so much pressure on Apple, they moved to putting a USB-C inside of every device, which has been great for consumers, right? So, the free market person in me says like they should be able to use whatever cable they want. and the environmentalist. And as a consumer, it's just so much better that everybody's on a USB-C. It's better for the environment. So I don't know where to stand on that one. I do think opening up an interoperability, that's a really great speeding ticket to give a company like Apple, where, they're so heavy-handed. Oh, you can't even tell people about a better deal they could get in buying direct from you. So I like those kind of actions. I don't like the blocking of M&A. It's killing the industry. It's taken an entire swath of returns away from our LPs, away from founders. And, it's just so important to have M&A back on the table, blocking Figma because, some regulators in the UK don't want it to happen seems crazy to me. And so I do think there's this possibility eventually where people will say, you know what, I'm just not going to launch my products in a region that's 10% of my revenue, but that's just too onerous to deal with. And that's where the EU might overplay their hand. And I think we're kind of getting towards that area where people might just say, it's not worth even launching my product in the EU, or I'm going to launch this like sub product. It'll be like, here's my Salesforce or HubSpot or Figma for EU under some shell company or something, unnatural acts to get around. Regulators could be coming for Europe, I think.
Logan, you're nodding your head. You've built quite a big franchise at Fin. How do M&As play out in your portfolio? How critical are they to the success of your funds?
Critical, and I'd agree with Jason just on certainly the Justice Department and antitrust environment here in the US, but also in the UK and EU. I was just in Europe for 2 weeks, and actually AI regulation was certainly a hot topic. The other topic was tax, right? So Labour Party looks like they're going to win here in London. And my colleague in London is sitting there looking at taxes that are going to go from 28% on his carried interest to 50%. Right. And I had a dinner for about 40 VCs, and half the room raised their hand when I asked them if anybody was thinking about leaving as a result of the tax issues. I think that's a huge problem. And so you think about just the regulation environment, the tax environment, those are spelling challenges just in terms of trying to be constructive about investing in the UK and EU, where we have 35 companies. On the M&A side, we just announced an exit a couple hours ago with a company of ours called Salt, selling to Chime. M&A is the lifeblood of venture capital, certainly in terms of our early stage book. Our PE book, where we invest from growth to pre-IPO exclusively in fintech software, we're underwriting to an IPO, but inevitably there's a dual track process. So M&A comes in place there as well. So to Jason's point, we're concerned about the uncertainty and certainly the time frame that it requires to be thoughtful and diligent and check all the boxes in terms of making sure a company will actually successfully prosecute an acquisition. As it relates to AI, in Vinod's comments, we fully agree. There's just going to be a ton of companies that will become roadkill here as they're trying to wrap existing LLMs, and they're not really building any true IP or defensible moats around their business. We're focused on vertical applications in AI, and then orchestration of AI in the enterprise, which is particularly important to the end customers we serve that have to deploy AI in many cases on premise. So very excited about our investments in AI. We have 20 companies there, and certainly more to come.
It's interesting you mentioned taxation. Some of the forward-looking LPs that I talk are rebalancing some of their portfolios towards venture capital with the assumption that all these things interplay with each other, specifically on the national debt in the US. Their assertion is that in 5 to 10 years, we're going to have to increase the capital gains on everything, including long-term gains. And with exemptions like qualified small business stocks, allows investors in the venture ecosystem to essentially pay no federal and sometimes no state income tax on their gains. So a lot of people are kind of thinking one step ahead in the US in terms of investing into asset classes that are going to be much more tax advantaged.
Well, just to that point, David, jurisdiction matters. And if you start putting your thumb on the scale too much, people in today's era are very willing to move jurisdiction. This is something new. I remember when I was starting my career in the 80s, 90s, you had to be in New York or you had to be in, the Bay Area. And now people are in Salt Lake City doing great work. They're in Austin, they're in Houston, they're in Miami, they're in LA. They could be in any jurisdiction. And then people are now starting to move to Singapore or to UAE, Abu Dhabi, Dubai. And these places are giving incredible incentives. Why would a venture capitalist in a large firm ever want to live in a jurisdiction that just killed them on with 50% taxes on capital gains, and when you could move to Dubai or you could move to Florida or, pick a location? I think you're going to see a lot of young people and maybe even some of the oldsters who are at the end of their career saying, hey, how do I manage this wealth transfer? Just pick new jurisdictions. You saw the Texas Stock Exchange coming. So this is serious momentum. And I think you have COVID in some way and remote work as the accelerant, right? If you can manage people and you could have a couple of people on the ground in Europe, but have your headquarters in Dubai or have your headquarters in Miami, and your analysts or you go to Broadway shows every now and again in New York for a couple of weeks, you kind of can get the best of the city and the best of the proper jurisdiction for running your business. What person wouldn't do that? A person with kids in school, maybe. That would be the only reason to not do it I can think of.
It is interesting. We just ran the simulation, as you mentioned, in COVID. One of the simulations was moving to Miami. We had so many people move from New York to San Francisco, and some people came back, but the people that really remain in Miami are investors. And I think governments should be thoughtful in terms of the regulations that they make for investors versus startup entrepreneurs. Many of the top startup entrepreneurs have decided to now go back to San Francisco, especially AI entrepreneurs, because there's such a ecosystem there. But I think governments that overregulate investors will find it to be a slightly different story. Logan, you also had some thoughts on what Vinod was saying around the other topics. What are your thoughts there?
Yeah, so I think thematically we're all seeing some frothiness in AI, where you've got several very, very smart PhD researchers founding a company with no use cases in mind, right? They're founding a company to found a company, and then they're backing into hopefully some use cases and monetization over time. We have to remember OpenAI was founded in 2015. First use case launched in 2022. Obviously, there were some non-for-profit aspects to that and some pivot, but that was a very lengthy period of time. We're now starting to see founders emerge from the Mistrals, the OpenAIs, the Anthropics, right? Because they're seeing real pain points and real use cases out in the market and spinning out to start their own companies. And our view, being a financial services and fintech investor, is that there's got to be application verticals within fintech. So that could be CFO tech stack tools. It could be compliance automation. It could be KYB, KYC, AML automation. It could be operational and docs processing. It could be improving your cyber capabilities in terms of deepfakes, which we think is a huge problem, particularly in the bank and the wealth management worlds. Or two, you could be helping people orchestrate, right? So we've invested in several companies on the orchestration side, like Articulate and Liminal, and we're going to announce another one in September that's just focused on how do I deploy on-prem, because everybody has to remember less than 8% of bank data is in the cloud. The banks have not adopted the cloud. And so they can't just ship their data outside of their four walls and expect to leverage SaaS tools for all the regulatory reasons that are familiar to all of us and only getting more constrained. So I liked his comments, and I frankly think he was pointing out some of the pretenders and those that will get consolidated or be roadkill, in his words, versus ones that will have sustainable long-term advantages. On the Apple side, the OpenAI partnership was interesting, but I think, as we all know, they're going to look at additional partnerships, much like Microsoft has. And in addition to that, just on the European comments, Apple announced that they're just not going to turn on AI capabilities in Europe. To Jason's point, it's like we're going to have like subversions across different countries because of regulation, and that's going to be to the detriment of small businesses and consumers ultimately. Yeah,
it's globalization is really interesting, and I remember when Airbnb and Uber were going around the planet. Sometimes you'd want to fight the good fight in a region. Other times you just said, you know what? We don't need to be in Austin. We don't need to be in Vegas. We'll be everywhere else. And then you know what happened? People in Austin and people in Vegas were like, we need Lyft, we need Uber, we need Airbnb. Like, we want these opportunities. Why are you? And then you all of a sudden, as a politician, become pretty unpopular. So if you're in Europe and you can't use certain AI features, then you're going to get a VPN. And you're going to VPN to get those features. You'll route around the government if you have means or intelligence. And if you don't, you're going to start complaining. And what are they going to do? Like, I have a VPN, and I'm, like, I can watch BBC with a VPN because it's free, and they can use Microsoft's Copilot or Apple's Copilot because they use a VPN. I mean, it's just, we're getting to the point of silliness here with too many restrictions. Now, it's your decision in a society to do that, but aren't the politicians supposed to work for the benefit of their citizens? And like, I don't see how this benefits it. And if you don't adopt AI, man, your country is going to get decimated. How are employees, for knowledge work companies in France or in Germany going to compete against knowledge workers in Manila, in the Philippines or Singapore or Portugal or, South America if they do have the tools? The answer is you're not going to compete. And then you're not going to get work. And then work will go to places where it's most efficient, cost and skill. And you're going to lose on both. Not a great idea.
Neil, how do you look to navigate AI world when it comes to investing into venture managers?
I mean, I think to Jason's point, just like, these companies need to adopt AI into their processes, the same is true of venture managers. And LPs are becoming cognizant of this and incorporating this into their diligence process. And ultimately, I think, what it does is it creates a significant advantage for VCs who historically have used data and have been quantitatively focused and, over time have been collecting this proprietary data, whether they're focused on a particular sector or a particular space in the market. I think, to the extent you're not doing this, you're going to get left behind. The other thing I think is really critical to Jason's point as well is you're going to need the team in-house to be able to separate from the roadkill and the disruptive companies, right? So, obviously, like the aspect of AI washing that we're seeing in startup community, the same thing we saw with kind of greenwashing in the climate space. It's important for VCs to have the technical skill set in-house to be able to determine when their startups are actually building good technology and in a position to do what they said they'll do.
Just on the one point about the Apple deal with OpenAI, they went through great lengths to talk about that deal being swappable, hot swappable. I think they're going to swap it out the second they get a chance. And I think it's going to get swapped out in one of two ways. Either to the highest bidder, like they did with Google and search, in which case your Apple stock's going to go up because that's going to be a pretty penny to be the default LLM on there. And these are cash-rich companies. So can you imagine, Claude, Grok, and OpenAI and Gemini all fighting it out to become the default, or not to mention Microsoft's version of OpenAI and their Copilot fighting it to be the Copilot on Apple's devices with those high-end consumers? Man, that could cost $10, $20 billion a year. Who knows? I mean, that could be just a huge check every year. And then the other possibility is they work on the open source projects and build their own and have complete control, which I think they plugged a hole because they didn't want Siri to be completely embarrassing and have their phone fall behind and then have other people saying, look what you can do on an Android phone that you can't do on an iPhone. So it was existential for them to plug the Siri embarrassment and have the ability for you to say like, hey, can you start my order in DoorDash, or can you call my Uber, and have Siri actually be able to do that correctly with AI? But yeah, this is too core to their business. They're not going to give up their iPhone franchise to anybody. I bet they have their own version that they'll slot in there, or they will buy a company, or they'll charge the highest bidder. I give like OpenAI almost no credit for this. I think it's like an instant swap out. I don't give them any credit. They just happen to be 6 months ahead of everybody else right now. I would place a bet in 5 years they do not have the default, or if they do have the default, they're paying billions a year for it.
Yeah, I was just going to jump in and say I think that they'll, rather than being one winner, there'll be multiple winners, right? So there may be somebody in the kind of the financial market space where Bloomberg GPT plays one role in kind of the medical space, and so I take the view that the data is so differentiated, the folks that have the best data in their sectors may ultimately be winners.
So you think Siri fires off the Bloomberg when you ask a stock question?
Sure.
Fires off like the WebMD or whoever's version, Gemini, if it's better for health. That's actually a really clever idea. I was thinking of it more like the search engine swapping or your browser swapping. But what you're saying is this might be so important. You might have 10 defaults. Who do I want for medical? Who do I want for entertainment? Who do I want for news? Who do I want for financial news? That's actually a really good idea.
The data sits in different places, so it'd be more efficient rather than having it centralized.
And a better user experience, I think, most importantly. Yeah.
It is wild that it seems like we're living in two different decades. You take your phone and you're like in 1990, and then you put on your computer and you're like in 2030, and you're switching between these different data sources. So it's wild to see that two of the largest consumer brands, Amazon and Apple, have basically been playing defense this entire time. It's a very predictable problem set that they haven't gone in front of. Moving on. On the latest episode of Allin podcast, President Trump declared support for increasing H-1B visas for highly skilled immigrants and even expanding it to any graduate of 2-year and 4-year programs. Since the episode aired, the Trump campaign has had to walk back the statements a bit, clarifying that it would not automatically be given to anyone that graduates any program and that there would be further vetting. Several conservative groups, such as the Conservative Immigration Accountability Project, have criticized the policy, saying that U.S. immigration policy must serve the interests of all Americans, not just the interests of elite business leaders who seek cheap labor. Logan, what are your thoughts on this?
So I was at Stanford Business School graduation in 2013. I was graduating and Mike Bloomberg was speaking, and he said emphatically, and I totally agree with this statement, that we need to staple a green card or visa to every single diploma in this football stadium. And it's done at the Stanford football stadium. And he meant that more broadly, obviously, than the cohort that was graduating that year. And I think we do such a poor job retaining talented immigrants in this country. And obviously, the NVCA, PitchBook, there's been a ton of data supporting the obvious, which is immigrants are founding amazing companies, particularly in technology in this country. And we treat them like second-class citizens when we should be bear hugging them. And so we, for example, pay for all visa and green card sponsorships within our own firm. We're sponsoring several now, and it's one of my kind of favorite things to do as a leader. And I think other VC and PE investors and certainly companies in technology should be advocating and pressing on this. And immigration policy in this country is broken. This administration has tried to make strides to fix it, but they've focused on the border immigration versus, I think, what is more low-hanging fruit, which is the H-1Bs and the talent that is leaving this country to go either back home or to other countries that are more accepting of them, like a Canada, for example. So I think Trump was hopefully leaning into saying the right things and then walked it back a little bit. But I'm hopeful that we continue in that direction.
I agree 100% with both Logan and Mike Bloomberg. I think one thing that both parties, I think, get wrong is that this belief that immigrants themselves want open borders, and I think it's just not true, right? Immigrants, particularly, my family's from India, and I speak to immigrants all the time, and all the immigrants I speak to are fiercely patriotic and really like the first in terms of being pro-America and being kind of the concept of being an American, the concept of as Americans we have the best universities and institutions in the world, and it's just silly that we force them out after training them and educating them. So 100% agree, and hopefully that's something we can pull off.
And Neil's got a great insight there about immigrants. They understand the value of immigrating to the country. They understand, in how hard it is to do that. And if they came in legally, it feels profoundly unfair, at least the ones I've talked to, when somebody, crosses the border illegally. And, they also understand the pain and suffering because they might know somebody who did make that really difficult journey. So, this is a highly charged issue. The reason I pushed Trump on it is I've been trying for close to a decade now to change the dialogue and reframe it. Reframing in psychology is just, like how you perceive the world, how you perceive a challenge or, something bad that happens to you, et cetera. So if you reframe it from immigrants coming across the border to commit crimes and to take our jobs and take lower wages, let's reframe it as recruiting. Okay, if we were going to recruit for this great country, if we are a sports team, who would we want to recruit? Well, we'd want to look at the current team and say, hey, what are we missing? Do we need a center? Do we need a point guard? Do we need 3-point shooting? Do we need a wing? What do we need on the team? What do we need on the team? We know that we need people to work in healthcare. We don't have enough of those. We need people who are nurses and doctors. We got a shortage. We need labor to work in restaurants. We have a shortage of that specific type of labor. We also need people who want to create companies and be competitive. Do we want people going back to India, to Saudi, to China, to Australia and creating their great company here? Or would rather they be building the companies here and we get the tax and we get the jobs? So there's a big picture, that you kind of have to reframe here. There's recruiting, there's illegally entering the country, and then there's compassionate immigration. Let's separate these things and make them less politicized and then put numbers on each one. Compassionate immigration, that could be, 100,000 people a year from countries where they are absolutely going to be politically prosecuted if they stay. Workers, well, that should just be based on our unemployment rate. If the unemployment rate is low single digits, we're going to accept 1 million people. If it's 10%, we're going to accept nobody, right? We're going to keep it, we're going to turn it off until the unemployment rate comes back down. You could actually have a very thoughtful, logical, mathematical, and recruiting-based discussion on this. And, when I saw them walk back my question and me pressing him on it, what I saw was there's a base of people who lost their jobs when, Bush, Clinton, globalization, Obama, we gave jobs to China, we moved factories out of here. That's the people who they're, I don't want to say pandering, but they're trying to address there. And they're also trying to address the issue of terrorism. Yeah, of course, we don't want this to be a back end for terrorists to come to the country. Yeah, some basic vetting, obviously. And we don't want people to hack the system. So it should be, people with green cards are tracked in a way that Americans aren't tracked. Like you will get pulled into an office with a green card. You will get stopped at customs with a green card. Anybody who has a family member or friend who's had a green card understands the anxiety they go through just going home. Can I get back in? Are they going to stop me? So that's kind of built into the system. I think that's what the Trump campaign was doing, is just making sure that those constituents don't feel like he's talking out of both sides of his mouth. And I actually like the clarification, because I didn't even think, oh yeah, some terrorist group's going to send 100 people here to go to University of Phoenix, shout out University of Phoenix, no offense, and get some Fugazi degree or something, and then blow up a building, God forbid. So I kind of like the walk back in a way. And Trump was, I think Trump 2.0 is being very thoughtful, and he's winning a lot of moderates. So maybe Democrats need to take some notes.
I don't think this is a partisan issue. I think this is a messaging issue. There's not enough people really advocating for immigrants, specifically highly skilled immigrants. The NVCA is really taking a leadership role here, but it's just one smaller group that's pushing for it. Just to give you some stats, 44% of Fortune 500 companies were founded by immigrants or their children. This isn't new tech companies. These are the Fortune 500, the bread and butter companies of the economy. 76% of patents awarded at the top 10 universities have at least one foreign-born inventor as well. And one of the interesting things about this policy is that we actually are able to A/B test it. Trump alluded to it, but there are people that were not given green cards that go back to India or go back to China or even go back to Canada or Europe and start these multi-billion-dollar companies. And what that has enormous multiplier effects on those economies, and that really robs us of the next generation of great companies. And one of the reasons the U.S. has really incentivized entrepreneurship is because entrepreneurship and the benefits of it don't just accrue to the founder. It's not just the founder getting rich and getting a tax break. It's also the employees. It's also the employees' taxes, the goods that they buy. All that effect goes into the economy. So I think if people really were educated on the multiplier effect that every highly skilled immigrant came in the country, I think it would go from a partisan issue to just more of a question of nuance. Do you want to really bring in everybody from a 2-year degree? Or maybe we should start with PhDs. Why is it that we have a single PhD in the United States that doesn't automatically get a green card? To me, that's a very low-hanging fruit. Or maybe we start with 4-year degrees. So I think we really need to continue talking about it and continue, leading with data on this issue. And I think it's going to be something that over time, just like anything that's kind of an obvious policy over time, it'll continue to gain steam and hopefully either in the Trump or Biden second term, something that we could get passed through.
I mean, did you guys see the interview? Did you guys have any questions for me on it or any thoughts on it?
Jason, what was your biggest surprise?
Biggest surprise. The H-1B visa was a really great moment, I think, for him to, show, hey, it's not just all xenophobia. And, that was kind of what that first administration, his first term felt like. And if he has a second term, I think maybe lowering that rhetoric and just having a more pragmatic approach to immigration would settle down a lot of the, I think, tension about his presidency and his personality. I think overall his tone is on a business program like All In was very what I put in that Trump 2.0, not insulting people, not that like rhetoric that makes everybody go, oh God, here we go again. It's going to be chaos. And I think he's running against himself. I think Trump is in 2024 is running against Trump's chaotic presidency the first time around. And I think people are going to make the decision, a lot of moderates, of do they believe this time will be more or less chaotic than the last time, January 6th, trying to overthrow the election results, depending on how strongly you feel about those two instances and just the general chaotic nature of it. And so if he can come across as presidential and refined and less chaotic and less name calling and less I'm going to be your retribution, that kind of stuff, I think turns off the moderates and they're going to flock to Biden if he's moderately cognizant. So to answer your question, he did a really good job. And I didn't expect him to be so presidential and focused and deft at speaking to the business community. And he's not my preferred candidate, but boy, does he come across better in that interview than Biden does, generally speaking, to moderates. And I'm just watching those moderates and women and wondering, I think women aren't going to vote for him, but moderates might. And I think he's got a pretty good chance of winning this. I don't know if you saw Nate Silver and other folks coming out today. They think he's got like maybe a 2/3 chance of winning. Yeah, 66%, 2/3 maybe.
Jason, you're still officially undecided. What are your top two issues?
Top two issues. Number one, I think we have to cut spending. Freeberg and I are both, concerned about that. And we talked about it here earlier. This existential spending is crazy. So we need less government. So that's definitely number one for me. I'm not too worried about the foreign wars, I'll be honest. I think actually they're pretty contained. Wars are terrible. There's always wars, and these two seem to be somewhat contained, right? Given how horrific wars can be. And I do think we need to have a very pro-business environment. So I'll put taxes, M&A, antitrust and immigration recruitment all in that bucket of just being pro-business. We have to keep pushing our advantage in building these next generation of companies like we all do here as capital allocators and founders do, because the world is getting decided by how good your companies do. It's really that simple. If you have jobs, if you have the best companies, you have the best tax base, you can basically win the global competition with your balance sheet. And I'm worried about our balance sheet. So I guess both of those issues are balance sheet related. Revenues coming in, incentives to build great companies. It's like a Ayn Rand novel right now. What are your number one and two issues, everybody, since we're already here in the deep end of the political pool? Issue one, issue two.
I think for me, immigration is important. Just having young children living in New York and the crime piece is something that I worry about. And then the economy, inflation, jobs, just general feeling, consumer sentiment, the way people are feeling obviously has a lot of effects on spending and business activity and startups and things like that.
On my end, definitely spend and business environment as well, Jason. I think spend's out of control. We're now getting notified by other countries, including the EU and UK, banks, respectively, central government saying, "Hey, look, U.S., you're spending way too much money," and we continue to do that. Particularly given interest rates, our servicing on the existing debt is incredibly high, approaching $1 trillion, right? So that can't persist. On the business environment, we continue to see laws around carried interest adjustments, and that's just going to create really bad negative incentive loops. We saw what happened when the California government in the middle of COVID, was going to pass a surcharge on carried interest, and we're all emailing Gavin and saying, "Hey, like if this happens, we're out." Right? We're all searching for homes in Tahoe, Miami, and Austin around those times, and many left. Right, and many have not come back. I think third is on defense and what we're doing there. I do agree. Hopefully, these wars are contained. I agree with some of the, hey, we need to fix our own problems at home versus sending money out, but we have a global role to play as we always have, and that will ultimately reap the benefits of stability globally that we've had long term. And so it's going to be a very interesting election. I think the challenge is that it's creating uncertainty alongside of obviously interest rates on the IPO environment. And between that and the antitrust issues, DPI is a huge question mark for so many. And that's that flywheel effect of LP return and then commitments and then deployment is broken for many of us. And I think that's going to continue to create meaningful challenges in the fundraising environment and create challenges and extended round dynamics for the portfolio companies.
It could basically take this incredible flywheel we have, and we're literally throwing junk into it. It's like, let the flywheel go. Stop throwing sticks and rocks and wrenches into the flywheel. We have the best capitalistic flywheel ever created in humanity, and we're somehow trying to, muck it up. Hey, we should be doing the opposite. We should be trying to accelerate it, make it even more well-oiled machine. We should have more company formation, more exits, more IPOs, more winning, and all of it trickles down. All of it results in that lowest unemployment of our lifetime, right? And if we keep screwing with it, and there's less companies and less M&A and less capital allocation, a lot of people are retiring, and you're not going to have a lot of productivity in the economy. And that's what we want. We want a productive economy where people are spending, and they're clenching it up. Don't clench up the machine.
I think the math on the national budget and on the economy in general is very simple. It's revenue in and costs. And the only non-zero sum aspect of that is company creation, is entrepreneurship. It's the thing that makes everything else possible. And although people argue about lower taxes versus more entitlements, that money has to come from somewhere. So I think if we just refocus the debate on how we can make it a better economy, it would be a rising tide that lifts all boats. Speaking of the economy, let's move on. Carta has released the average amount of time from incorporation to important funding milestones, and the data is around 14,433 primary rounds. The median amount of time to raise a Series A was 3.1 years, and the median amount of time to Series D was a whopping 8.1 years. Logan, what are your thoughts on this?
I'd be really interested to see this data split between 2019 to December of 2021 and then 2022 through May, right? I have a feeling the median's been pulled upward as a result of the non-ZIRP environment. And I think as we've all observed, rounds are taking longer. The pendulum has swung back to investors' hands in terms of valuation and multiple consideration, more structure in rounds, and more structure means longer negotiation times, more legal documentation, et cetera. And then third, less competition. And I think on the less competition side, that's a double-edged sword. It means there's more leverage from investors to be able to say, hey, we're the only game in town. We're going to put a bunch of structure in place, and we're going to have meaningful dialogues around the valuation of the multiple. And then insider and bridge rounds also take longer, right? Because everybody at the board is pointing to somebody else. It's like, who's going to lead this? Who's going to price this, right? So I'm not surprised at all by the data, but I am, in some of Carta's analysis, I wish they would have some macro overlay. And I'd be curious, and I'm guessing, right, that this 2022 through May of 2024, the median got pulled up meaningfully. And a large percentage of that kind of 8.1 years in the Series D timeframe has been driven by the last couple of years, where it's just been much more challenging to get financings done. And the bar of metrics and efficient growth, particularly for those Series D companies where people want to see profitability or near-term profitability, are so much more important to investors.
Logan, you have a healthy growth equity franchise. What are you seeing on the ground today in the growth equity side in the later stage rounds?
We're seeing companies that are growing efficiently. We have to remember top decile IPOs from a growth rate perspective is 30%. So if you're growing at 30%, you go public, you're in the top decile. That's pretty amazing, given that we all thought 60 to 80% growth was what good looked like. And so if you can tell a company, grow slower, bring EBITDA forward, and improve your gross margins and position yourself to have top decile SaaS metrics, because this is software data here, before you go public, or give yourself the ability to control your destiny on the M&A side, so you don't have to force an equity financing that will probably lead to a recap and restructuring of the business, right? And massive dilution for the founders. So I think that conversation's happening every day at the board level, and certainly within our growth and PE book. And then we have a number of companies that have filed to go public or in the IPO queue. They look like public companies and they just won't get out, right? I love Dan Premack's piece the other day where he's like, hey, just a reminder, the IPO window's open, people, right? Let's go. Let's go.
It's definitely the rules. When the rules change dramatically from the ZIRP to a high interest rate environment, and it's hard to close around, you see behaviors change and people have to try to adapt. And all of a sudden, 100% growth, but burning money is just not as attractive as 30% growth with a line of sight to break even in profitability. So you have to be nimble as a founder, especially at the later stages, and understanding like, hey, what's the overhang on this company? How much preference stack is there? And did we raise at all those warnings about raising too much money or raising at too high of a valuation? Now we're seeing why that advice came from the elder statesmen and stateswomen. Like, they've seen this movie before. You raise at too high of a valuation, you get caught in this valuation trap. And now how does anybody on the management team ever make money? How does their equity become worth something? You look at Instacart, that became an $8 billion company, private market valuation, 30, 40 billion, I think the last one. So these are really hard, formulas to try to net out. And a lot of it just has to do with capitulation at a certain point. Like, this company's been private for far too long. Reddit's got to get out. Instacart's got to get out. At some point, Stripe's got to get out. Adyen's still private, I think. So yeah, people need to get these companies out there. When you look at the data from Carta, PitchBook, or any of these places, they're generally, because there's private company data, it's not going to be perfect. And you have to maybe squint a little bit, look for trend lines, because Carta's data is a subset of people who use Carta, right? That's all they have is Carta data. They don't have the companies that aren't in Carta. And so, the fidelity of this data is probably imperfect, but the trend is probably correct. It's taking longer. And then there's a lot of nuance in here, which is people are doing a lot of convertible notes. And so they're not naming their round Series A, Series B, Series C, but you'll see a convertible note for a $5 or $10 million round with nobody joining the board. These are really concerning to me. I just passed on an investment because they don't want to start a board. They don't want to have a board. I would have done it. The lead investor doesn't want to have a board. We're like this, we would have been the second lead. We would put less money in, but we want to have a board seat. We want to have at least an observer seat. People don't want to have governance. They want to raise large amounts of money. I just have a problem with this approach to building businesses, because I watched Bill Gurley and Michael Moritz and Doug Leone and these folks Jim Getz build these businesses, and they seem to take it seriously. And these like never-ending convertible notes, no board meetings, $1 million in ARR, no plan. Like, can we make plans? Can we have a board meeting where we talk about the plan and if we're on a plan or not? Like, I think the industry got a little bit loosey-goosey. And I think this is all a process of tightening things up, right? And it's arduous, it's painful, but it's necessary.
Logan, do you see a lot of structure in the market? Do you see people putting 1.5x, 2x pref in the late stage?
Absolutely. Quick record correction. So Adyen is a public company. They went public in 2018. We own and like the stock. And on the lick pref, ratchets, warrants coverage, deeper discounts on safe notes or convertible notes. All those things are back in vogue. We never could approach those conversations in 2021, 2020, 2019, maybe 2020, right? So in 2020, with some COVID uncertainty, there was definitely some structure that quickly dissipated going into 2021, and now it's back from 22 into the present. We all have to remember 2009, 2010, 2011, three best venture capital vintages in history. Terrible macro, awesome returners. And if you sat on your hands those 3 years, you missed Airbnb, you missed Uber, you missed Stripe, you missed Plaid, on and on and on, right? It's a long list. And so from our perspective, we were the most active fintech investor in the world last year. We finished second next to Tiger, as did the rest of the world in 2022. And that's because we saw more structure, better EV and multiples, and less competition, which is, as we all know, the number one driver of valuation dynamics versus fundamentals in private markets.
So you got to spend more time with the management teams, make more thoughtful
Absolutely.
decisions, and then create a structure where, if people were optimizing for valuation, you had some downside protection. Yeah. Seems like thoughtful behavior to build meaningful businesses. And, that's what's got me very excited. I've been a capital allocator just over 10 years. As you guys know, I started as a Sequoia's first scout, right? And, I'm just the quality of the companies and the seriousness at which people are building businesses reminds me of when I made that Uber, Robinhood investment 10 plus years ago. Feels like people are serious, because if you're not serious as a capital allocator, you're just not going to raise your next venture fund. The statistics on people not raising their next funds, I think, David, you brought that statistic up once on this pod. I mean, it's pretty crazy. People are now saying, yeah, maybe I won't do another fund, or, and so maybe there'll be less investors, and maybe there'll be more board meetings, and maybe there'll be more planning and less foosball and Aspen 6-week trips and people being on silent retreats, and maybe more work ethic. I'm starting to sound like Trump or like an old man, but there was a period there where I was just watching behavior in just going, I think I am a seller right now. And we did like 3 or 4 secondary transactions. I did personally with my Uber shares, some secondary transactions with Masayoshi-san. And then we just sold some shares in peak ZERP era. Because I said, I don't understand how you're valuing this company at 50 times top line revenue. But if you are, I guess I'll sell 20% of my holdings. Sure, why not? But now it feels like being a buyer is a good idea. Like, some of these SaaS companies are trading at absurdly low multiples and in public markets. So maybe, we should all just be buying them. And 50x for a private company that's growing 30%, 7, 8, 9x for a company that's growing 30% in the public markets, that's liquid. I mean, so the great rebalancing is still happening, I think.
Neil, what are your thoughts on the Carta data?
I think from a macro perspective, zooming out for a second, it feels like we're in a correction for venture, by what's going on and what you're hearing in the space. But if you're zooming out and you're looking at more of a 20-year track, a 30-year track, it's really not. It's more of a return to the mean. To Logan's point and to Jason's point, I think it's good. It's cathartic, right? It forces companies to be scrappy. It forces companies to think outside the box. And that's when the greatest American companies were created, when it wasn't a ZERP environment. They were forced to be creative with their problem solving. So I mean, I'm bullish on America, bullish on venture, and I think it's a great time to be an investor.
Well, speaking of great times to be investors, let's go on to lightning rounds with everyone's latest 3 investments. We'll start with Logan.
All AI companies, shocker. So Liminal.ai, Healthy.ai, and Articulate.ai.
Tell us about each one. Yeah, what do you love about each one of them? Yeah,
happy to. So Liminal and Articulate are in that orchestration middleware theme I mentioned earlier. So I'll start with those two. Healthy's in the application vertical. So Liminal is, I'm a bank or I'm a healthcare provider or I'm a government. I have source of record data. I have PII. I probably have social security numbers and date of births and all kinds of very sensitive data. I have regulated data. I still want to use AI. how do I get source of record data to application and use AI without disclosing all of that, right? And liminal is basically that pipe of data sitting in between those two things. And so they can encrypt, and then they can extract data out that you don't want to be sharing. And we think that's incredibly important for this orchestration problem, right? We have still a massive crossing the chasm moment for enterprise adoption of AI. It's just not really happening in these large enterprises yet, right? Outside of some Copilot use and some playing around with ChatGPT. And so we think orchestration and middleware is a massive theme. If you think about where money was made in the cloud, if you look at the return pie of just the cloud wave, and that wave is still going on, but 80% of the returns we estimate in the cloud transformation were made by public equities. Where was the money made in the private markets? It was made really by the on-ramps to the cloud and the orchestration and middleware players like a Snowflake. Same thing we believe is happening in AI, where 80% of the returns are getting made by NVIDIA, Microsoft, Google, et cetera. And the 20% is going to be a little bit of application, maybe some of these LLMs, although we definitely are seeing some commoditization there, and there's going to be one or two winners. But third, we think there's going to be massive power in orchestration. So that's what Liminal does. Articulate carries that theme where they're focused on deploying generative AI on-prem. So again, if I'm a regulated player and I actually want to use an LLM and I need to deploy it on-prem with the right integration and so forth at scale, I'm going to use Articulate to deploy that. This was also our very first investment where we took a public team. So this was Intel's AI team, and they spun out to form Articulate. Intel basically figured out we're not going to keep up with NVIDIA. We have this amazing AI team that's about 50 people. Let us support the spin out, working with a couple of investors to help drive this company forward. So we think that's super interesting. And then third is healthy. So we all really struggle as employers and employees of picking your healthcare plan, right? As well as understanding your benefits. And healthcare insurers are just designed to try to suboptimally provide you healthcare. Healthy helps you navigate that journey. So both for me and all you guys who are making decisions about your employees in terms of what healthcare benefits and plans you should be providing to them optimally based on geography, age, demographic mix, et cetera. And then Healthy provides effectively an AI agent to say, hey, does my insurance cover this? How many times can I get physical therapy? All these questions that you have to typically call an 800 number for. Healthy helps you navigate predominantly through payroll and benefits providers. So really excited about those three investments.
Yeah, three strong ones. Neil, what do you got?
So not as interesting as Logan, but most recently, my two most recent investments were in the private credit space. I did one with Blue Owl, big kind of private credit manager. Also with Star Mountain. I think private credit continues to get a lot of interest from big family offices. Maybe a little bit more interesting is I did a recent investment in a fund called Guardian. Life settlement space, super fascinating. What really attracted me was that I learned that 92% of life insurance policies in America expire worthless. So only 8% of the time where in America you're buying a policy does someone actually collect the death benefit. So that creates this huge secondary market that is largely untapped by institutional investors. So this group, they've been doing this for a long time. They started flipping these policies and they built a fund around it. And it's actually quite novel that you can leverage the advances both in AI and medical records to quickly make decisions on these policies and build a portfolio around diverse geographies, diverse life expectancies, diverse in terms of size of investments, and ultimately it's fascinating because there's a huge appetite upstream from the TPGs and the Apollos of the world. So they package these policies up and flip them, and then they keep policies on their balance sheets what they think are most compelling. So that's what I'm working on.
And I guess that shows just that there are other options for family offices to put their money to work other than venture, and we're in a competition to get returns, and we have to prove it on the playing field. Krepling's a great company that is building on this incredible e-commerce revolution that's occurring, and they let you, with a very simple drag and drop interface, as you can see here, build sequences for customers. So somebody registers, then they join your mailing list, they order something. oh, they abandoned their cart. Now I want to retarget them with this specific ad based on that SKU or SKUs that are also put into people's, buckets. This is incredibly complex stuff that maybe a Nike would do or an Amazon might do, but that generally has not been available to your average mid-sized or smaller e-commerce vendor. And so that's Krepling.com with a K. AI and computer vision obviously is in the real world gonna help make everything better, faster, cheaper, right? And that's just such a winning proposition. Quick service restaurants really need to monitor how long people are in the drive-through, right? And you're dealing with low-wage employees. Maybe they're not focused at work. Maybe they had a gummy or something. Who knows? Anything can happen. And so they're using computer vision and AI to watch people, through just standard cameras coming around a restaurant's drive-through or inside of the restaurant, and then watch with computer vision how long it's taking these vehicles to get through the restaurant, or what are people doing? How long are they in line for? What's going on with the dining room? All of this from, door to dine and to manage your drive-through. And then also you get a little bit of security benefit. Maybe people are stealing. Maybe there are people, who shouldn't be in the facility and this is all done by a company called hellometer.io that we found, just computer scientists making things better, cheaper, faster using AI. Really clever company. Valley doing something similar, using AI to take SDR, sales development reps, which are kind of the front line of every SaaS company. Everybody understands there's millions of people selling SaaS products and business solutions. How do you pick the next best customer? Well, you typically have an SDR out there finding a sales development rep, trying to nurture leads. What if this could all be done by AI? What if you could have your schedule fill up? And so basically you set up Valley, you give it access to your data, Salesforce, HubSpot, whatever you're using. You got your prospect list, and then it uses AI to book sales calls. And so we believe that SDRs will either be made bionic or be AI or some combination of that. And that's what joinvalley.co is doing. It's called Valley. And they want to be your highest performing SDR for only $500 a month, joinvalley.co. And these are all, early stage companies, which is our specialty at launch. If you want to apply for funding, launch.co/apply, get a meeting with my team.
I like both of those companies, Jason. Hellometer.io I just sent to my dad. We're very large owners of Five Guys. So I'm going to get you some customers on that one.
You guys own Five Guys franchises?
A bunch of them, yeah. So
that's got to be the nuts, man. I love Five Guys. Those fries.
Yep.
And then also I love, they're very generous with the peanuts. I love getting those peanuts while I'm waiting. But those French fries and that burger, that's right now for me. I go right now. My order is Five Guys, Shake Shack, In-N-Out. But sometimes Shake Shack it goes above. It just depends on my mood. But I love those.
I'll work on getting Hellometer in there. We'll get you some free food.
There you go. I don't need it. I don't need any free food, man. I just lost the weight.
It's dangerous.
Anybody else got a burger ranking? Anybody else got a stack ranking for their burgers? You got to stack rank your burgers.
I'm a big Chick-fil-A guy. I'm going contrarian here. I'm going chicken.
What do you like? Spicy chicken? You're a spicy chicken guy. Aren't you?
Spicy,
breaded?
Grilled chicken. Yeah.
Oh, you go grilled or you go
grilled?
fried?
Yeah.
Oh, so healthy but spicy.
Keep it relatively healthy. Yeah.
I like it.
And the fries. I'm a big fan of the fries at Chick-fil-A.
Have you ever tried Schnippers in New York, Jason?
Schnippers, no.
Schnippers, yeah. So it's in Midtown. So we used to have an annual at my office, an annual burger contest, and we would do like blind taste testing. It was a whole big thing. So it was either Five Guys.
I'm looking at this.
Five Guys or Chick-fil-A were typically the winners.
Yeah, I had a friend, and he started when I lived in New York in the 90s and 2000s, he started a burger club. And all he would do is find the next great burger, and, a half dozen of us would go take over and get the burgers and rank them. But here's your Schnippers. It's a good-looking burger. All right. There you have it, folks. Take us out, David.
Another great episode of Liquidity Podcast for Logan Allin, Neil Datta, Jason Calacanis. This is your host, David Weisburd. Thanks for listening.
See you next time.